You think the banking system is one system. It isn't. There's the one they built for you, and there's the one they built for everyone else. Now, I'm not talking about better customer service. I'm not talking about a black card or someone who picks up the phone when you call. I'm talking about a completely separate financial reality. Different instruments, different tax treatment, different legal protections, and in some cases, accounts you are literally not permitted to open, regardless of how much money you have. Not because your credit is bad, not because of your history. In some cases, simply because you were never introduced to the right person. By the end of this video, I'm going to walk you through that world, tier by tier, all the way to the top. And I mean all the way. We're going to reach an institution where you could walk in with $1 billion in cash and they would turn you away. Not because you're not wealthy enough, but because you are simply not eligible. That account does not exist for you. But let's start at the beginning, because the first thing you need to understand is how this separation was built and why most people never see it. Here's the version of banking most people carry in their heads. You have an account. Rich people have a nicer account. Maybe there's a private banker who knows their name, a card with no spending limit, and a lounge somewhere with good coffee. That's not what this is. What separates the financial world you live in from the one I'm about to show you isn't comfort, it's access. Legal access to instruments, structures, and strategies that are not available to everyone else, not as a policy preference, but as a structural and in some cases statutory reality. The line that draws this separation is drawn at a very specific number, not your income, not your total net worth, your investable assets, liquid capital that can be immediately deployed. Your primary residence doesn't count. Your business equity doesn't count. Cash, stocks, bonds, that's what they're measuring. And the line is $10 million. Below that number, you are, in the language of the financial industry, a product consumer. The bank sells you mortgages, credit cards, savings accounts. You are the customer, yes, but not in the way you think. Because in retail banking, the bank's real product isn't the mortgage. The real product is access to your financial behavior, sold to data networks, to advertisers, to the secondary market for your debt. Above $10 million, something fundamental shifts. Institutions like JP Morgan Private Bank and Goldman Sachs Private Wealth Management stop selling you things. They transition from an advisory model to a discretionary one, meaning they manage your affairs with the same tools, the same institutional infrastructure, and the same intensity used for sovereign wealth funds and university endowments. You go from being their customer to being their client. The relationship inverts. But here's where it gets interesting, and this is where most people's understanding of private banking stops before it reaches the good part. The most powerful thing that changes at $10 million isn't the service level. It's what you're legally allowed to do with your money. And the first example is something most private banking clients themselves don't fully understand. Let me ask you something. How much of your money is actually protected right now? Most people in the US know the answer, $250,000. That's the FDIC insurance cap per institution. If your bank fails, that is the ceiling on what the federal government guarantees back to you. Anything above that goes into the creditor queue. For a retail client, that cap is simply the reality. But here's what happens at the private banking tier that most people have never heard of. When a private banking client deposits $20 million, the bank quietly runs it through a program called IntraFi. Behind the scenes, that $20 million gets broken into 80 separate $250,000 deposits, distributed across 80 different member banks simultaneously. The client receives one statement, one relationship manager, one phone number. But every single dollar of that $20 million is technically 100% FDIC insured because it's held in legally insurable increments across dozens of separate institutions at once. You are capped at $250,000. Private banking clients have no effective ceiling. Same government insurance program, completely different outcome. But that's almost the least interesting thing that changes, because the deposit protection is just the floor. What really separates this tier isn't how your money is protected, it's how it works. In the retail world, when you invest in a mutual fund or an ETF, you don't own the underlying securities. You own a share of a fund that owns those securities. That distinction feels technical until you understand what it costs you. At the private banking tier, clients invest through what are called separately managed accounts, SMAs. In an SMA, the client directly owns every individual security in the portfolio, every stock, in your name. And because you own the individual positions, your banker can sell a specific losing position to offset gains elsewhere in your total financial picture, with surgical precision, in real time. Tax loss harvesting at a level that is structurally impossible inside a pooled fund. Northern Trust alone manages approximately $150 billion in these custom SMAs as of mid-2025. At this level, the tax savings from an SMA often pay for the entire banking relationship. Now, here's one that's written into federal law. Pay attention to this, because this is where the separation stops being about service and starts being about statute. Under the Investment Company Act of 1940, there is a legal designation called a qualified purchaser, an individual with $5 million or more in investments. Cross that threshold, and you unlock a category of fund called a 3C7 fund. 3C7 funds are exempt from SEC registration. They file no public disclosures. They run the most sophisticated, most illiquid, highest alpha strategies in the global market, strategies that institutional hedge funds use. And they are legally inaccessible to everyone below the qualified purchaser threshold. Below $1 million in net worth, registered mutual funds and ETFs. That is your legal universe. Above $5 million in investments, you can access funds that do not technically exist in the public financial record. That is not a preference. That is a law. There is a wall, and the wall has a very specific height. But here's the catch. The accounts I really want to show you, those aren't even in the $10 million tier. Some of them, money alone, will not open. And that is a completely different kind of locked door. I want you to picture a bank. No advertising, no app, no public-facing website with a Get Started button. If you call them and ask to open an account, they will decline. Not because you don't qualify financially, because that is not how it works. C. Hoare & Co. has been operating continuously since 1672. It is the oldest privately owned bank in the United Kingdom. And to be considered as a client, you need two things that no amount of money can manufacture. First, written recommendations from two existing clients, people who will stake their own standing with the bank on your character. Second, an in-person interview with a partner of the firm. Your financial profile is secondary. Your reputation is the application. This detail changes everything about how we think about exclusivity in finance, because the most impenetrable door in the world isn't one that requires a higher number, it's one that requires the right introduction, and you cannot manufacture that. C. Hoare is not the only institution built this way. In November 2025, Coutts & Co., the bank that has served the British royal family since the 18th century, raised its minimum wealth threshold for new clients to £3 million, a tripling of the previous £1 million minimum, almost overnight. But here's what made that move more significant than it appears on the surface. Coutts was explicit about something. The minimum is not the point. The client's professional network, their reputation, the kind of person they are, these carry as much weight as the balance. They were not raising a price, they were narrowing a filter. They are not looking for the richest client, they are looking for the right client. Now, there is a third type of account at this tier that most people have never considered, and it might be the most counterintuitive thing in this entire video. In the retail world, access to your money is assumed. Your savings account is always there. That is the implicit promise of every bank you have ever used. At the highest tiers of private banking, the best yielding accounts are specifically the ones you agree not to touch. They are called notice accounts, and they work exactly as the name sounds. To make a withdrawal, you are legally required to give advance notice, 35 days, 90 days, sometimes 180 days. This is not an early withdrawal penalty. There is no penalty. There is simply a contract that says your capital is deployed and it cannot be retrieved until the notice period expires. Why would anyone agree to that? Because while their capital is locked, the bank is deploying it into illiquid private credit markets, generating returns that no instant access savings account can approach. Liquidity is being traded deliberately for yield, and at this level, that trade is worth making. Retail banking is built for people who might need their money at any moment. Private banking is built for people who don't. There is one more institution worth naming at this tier, LGT Bank, owned by the princely house of Liechtenstein. Minimum 1 million euros. What they offer is something called the princely strategy, a structure where your capital is deployed alongside the royal family's own balance sheet. Same alternative investment toolkit, same private equity access, same underlying infrastructure. Not a product designed for wealthy clients, an alignment of interests between you and one of Europe's oldest ruling houses. At this point, you might be wondering, if private banking is already this inaccessible, what exists above it? I haven't shown you the real ceiling yet, but before I get there, I need to show you the mechanism underneath all of it, the strategy that makes everything at this level possible. Because once you see it, the rest of this video lands completely differently. The goal of ultra-high net worth banking is not high returns. The goal is liquidity, without taxation. And there is a 3-step legal strategy built directly into the United States tax code that the wealthiest people in this country use to fund their entire lives without ever triggering a taxable event. It has a name. Once you know it, you will start seeing it everywhere. It is called buy, borrow, die. Step 1. Buy. You acquire appreciating assets, concentrated stock, private equity, commercial real estate. Under IRC Section 1001, no tax is owed until a realization event occurs. A realization event means a sale. As long as you don't sell, the IRS is not involved. The asset can double, triple, increase tenfold, and the tax liability sits dormant, unrealized, untouched. Step 2. Borrow. Instead of selling assets to fund your life, you use them as collateral for a Lombard loan, a secured credit line where your investment portfolio backs the borrowing. Under federal law, loan proceeds are not taxable income, not a single dollar. Private banks at this tier lend 50 to 85% of a portfolio's value at interest rates of SOFR plus 0.5 to 1.5%. Right now, that puts the borrowing rate at roughly 5 to 6%, while your portfolio grows at 8 to 10%. You maintain a positive spread. You fund your lifestyle entirely from loan proceeds. You pay zero income tax, zero capital gains tax, indefinitely. And they'll lend against more than just your stock portfolio. Classic cars, fine art, private aircraft, pre-IPO shares in companies that haven't gone public yet. Any asset the bank can value becomes potential collateral for tax-free liquidity. Step 3. Die. Under IRC Section 1014, when you die, your assets receive what's called a stepped-up basis. The cost basis, the number the IRS uses to calculate your capital gains, resets to the fair market value at the date of death. Your heirs sell the assets to repay the loans. Decades of accumulated appreciation legally erased. The capital gains that should have been taxed across an entire lifetime disappear from the tax system entirely. Borrow at 6%, grow at 10%, die with a stepped-up basis. That is not a loophole someone discovered by accident. That is the architecture. It was built this way. But here's what they don't tell you about the next layer up, because even buy, borrow, die has a wrapper that makes it more powerful, and it comes disguised as something most people would never look twice at. For those at the very top of this tier, there is a structure called Private Placement Life Insurance, PPLI. You pay a premium, typically $3 million or more, into a policy. The insurance company places those funds into a private fund managed by a hedge fund or private equity firm of your choice. Inside that policy, the assets grow completely tax-free. No annual tax filings. No drag on dividends or short-term gains. During your lifetime, you can borrow up to 85% of the cash value, tax-free. At death, the entire account, every dollar of accumulated growth, is paid to your beneficiaries as an income tax-free death benefit. The assets never leave a tax-protected wrapper. From the moment they go in to the moment they are inherited, the tax system is never triggered. Now let's dig a little deeper, because everything I've shown you so far still exists within the framework of private banking. What comes next is where that framework ceases to apply entirely. Above approximately $100 million, something changes again. The private bank is no longer your manager. It is your custodian, your infrastructure provider. The institution holds your assets while you, or the team you've assembled, make the decisions. The relationship inverts, one final time. This is where single-family offices enter the picture. A single-family office is a private firm, built, staffed, and operated exclusively for one family, that manages the entirety of that family's financial life. Investments, tax planning, estate structuring, legal affairs, in some cases, private security, aircraft management, philanthropic strategy, everything under one roof for one family. Now here is the part most people miss. Under the Dodd-Frank Act of 2010, the SEC created a specific legal exclusion for these structures, Rule 202A11G-1. Under this rule, a qualifying family office is not classified as an investment advisor. It is exempt from the Investment Advisors Act of 1940. It files no public disclosures. It operates at the scale of an institutional investment firm, with almost zero public transparency. There are approximately 8,000 family offices operating globally right now. They manage an estimated $5.5 trillion in assets. By 2030, that number is projected to reach $9.5 trillion. North American family offices account for nearly 40% of that total. $5.5 trillion, managed in private, largely invisible. But here's the detail that makes this structure truly permanent, and this is the point that most financial analysis never actually reaches. The SEC defines the eligible family members who can be served by a family office as all lineal descendants of a common ancestor, going back up to 10 generations. 10 generations is approximately 300 years. That means a single, unregulated, private financial firm can legally manage dynastic wealth for centuries. Not until the next market cycle. Not until the next generation. For 300 years, with no requirement to file a single public disclosure. That is not a wealth management structure. That is the architecture of a permanent private financial dynasty. And if you want to understand how that dynasty is legally sealed from the outside world, there is a piece of state law in South Dakota that most people have never heard of, and it may be the most quietly powerful financial provision in American law. It is called a quiet trust. A quiet trust allows the creator of a trust to keep the very existence of that trust secret from its own beneficiaries. The people who will one day inherit the wealth don't know the trust exists, don't know its size, don't know what it holds. Furthermore, South Dakota allows trust-related court documents to be permanently sealed. Journalists cannot access them. Creditors cannot access them. Disgruntled family members with legal standing cannot access them. In 2021, the Pandora Papers, 11.9 million leaked financial documents from inside the global wealth management industry, confirmed what investigators had suspected for years. South Dakota had quietly become one of the most effective financial secrecy jurisdictions on the planet, on par with Switzerland, not offshore, domestic, right here. Now, here is the part of this story I want you to sit with, because here's what the US built while positioning itself as the world's enforcer of financial transparency. The Foreign Account Tax Compliance Act, FATCA, forces foreign governments to report on American citizens' overseas accounts. If you hold money in a Swiss bank, Switzerland reports it to the IRS. The US created the global standard for financial transparency enforcement. But the US has not fully reciprocated under the Global Common Reporting Standard, the CRS. The US collects information. It does not share at the same level. The result? The United States has become the world's leading onshore tax haven for foreign elites. Wealthy individuals from Ecuador, Russia, the Dominican Republic, they are moving capital into South Dakota and Wyoming trusts specifically to hide it from their own governments, not from America. America isn't the concern. They're hiding from home. The country that built the global transparency enforcement mechanism built the world's most effective secrecy structures inside its own borders. And above all of it, above private banking, above family offices, above quiet trusts and dynasty trusts, and the entire architecture of wealth preservation, sits one institution that makes everything else look accessible by comparison: the Bank for International Settlements. Headquartered in Basel, Switzerland, founded in 1930 by international treaty, the oldest international financial institution on Earth. It is owned by 63 central banks. Those 63 central banks represent 95% of global GDP. It operates under a unique legal status that grants it immunities from national jurisdictions, and it does not accept deposits from private individuals or corporate entities under any circumstances for any amount of money. You could walk in with $1 billion in verified liquid assets. They would turn you away, politely but completely, not because you are not wealthy enough, because you are not a central bank. You are simply not eligible. The account does not exist for you. That is the ceiling. Here is what I want you to walk away with. None of what I just showed you is hidden the way most people imagine. The buy, borrow, die strategy is in IRC section 1014, published in the US Tax Code. The Quiet Trust provision is publicly accessible on the South Dakota State Legislature's website. The family office exemption was printed in the Federal Register, in plain English. The system is not secret. It is designed so that by the time most people become curious enough to look, they have already decided it doesn't apply to them, that it is someone else's world, that it is too far away to matter. But you just saw it, tier by tier, from the $250,000 priority banking floor all the way to the institution that will not open an account for any private individual on Earth at any price. The question was never whether this world exists. The question is where you decide to position yourself relative to it. If this video gave you something real, hit like and subscribe before you leave. Most people watching this channel right now aren't subscribed, which means they miss everything that comes next. And what comes next matters. Because understanding that this tier exists is one thing. Understanding what actually separates the people moving toward it from the people who aren't, that's the closer question. And it usually isn't income, it isn't savings rate. A lot of the time it comes down to decisions so small most people never notice them, until the gap they've created becomes impossible to ignore. That's exactly what the last video was about. The subscriptions that quietly separate wealthy people from everyone else. Not the obvious ones, the ones hiding in plain sight, financial tools that the top 1% treat as infrastructure, while everyone else walks past them every single month without a second thought. It's already up, and if this video landed for you, that one will too. I'll see you there.